Sometimes rolling an account into your own IRA is exactly the right answer. Sometimes maintaining an inherited IRA for some period of time, at least, may provide valuable flexibility. The mistake isn't necessarily making a wrong choice. The mistake is not realizing you had a choice at all. Welcome to another episode of the Simply Retirement Podcast, where we want to educate and empower women to live your retirement on your terms. I'm your host, Eric Blake, practicing retirement planner for over 25 years, founder of Blake Wealth Management, and I would not be the man I am today without the women in my life. Joining me once again is Wendy McConnell. Wendy, how are you?
I'm good. How are you?
I'm doing very well. So I'm counting down days. I am just over a week from our big trip, our Grand European riverboat cruise. So
just a week.
Just trying to get everything wrapped up, tie up all the loose ends, all that fun stuff. So it's we're very excited, but as always, there's a lot to get done before then.
Where are you catching the boat from?
So we go Budapest up to Amsterdam.
Okay.
And we got a couple of extra days. So we actually the boat leaves on the 10th. We get there get to Budapest on the 8th. So we've got call it a two-day buffer there just to hang out, see what's there in Budapest, and
okay, then
we're good to go. So I'm excited.
I am very excited for you. It's an amazing. I'm sure it's going to be an amazing trip.
I think so. We've gotten a lot of great feedback. It was actually recommended by a client that has done it a couple of times, and it's our 30th anniversary. So we got that on top of everything. So it's an exciting, we're definitely excited. We're going to not be able to see the grandbaby. She's actually here with us right now. So
okay.
That's going to be interesting to see if we figure out how to FaceTime from Europe.
Yeah. Well, I'm sure you can do it. I'm sure you can, but
we'll make it happen.
I hope you have the time of your life.
I'm extremely excited. It's going to be fun. So
okay.
It's overwhelming a little bit just to think about it, because it's the first time we've gone this long away from the business, which the good thing is obviously I've got my son and my daughter on board now, so they'll be able to keep the ship afloat.
Pick up the slack. Yep.
But yeah, it's going to be fun. Well,
I can't wait to hear all about it. So
absolutely. We may just do an episode just on that. That may be a topic all to itself. So today I do want to spend some time talking about, I think, what's one of the most important financial decisions that many widows will face after losing a spouse. And that is what to do when you're inheriting an IRA or even a 401k, and how that decision fits into the bigger picture of retirement planning. And over the years, I've noticed something very interesting, and that is most widows understand, of course, that losing a spouse changes their finances, right? That's pretty obvious. But what many don't realize is that one of the first financial decisions that you have to make after that loss could affect your taxes. It could affect your income planning, your healthcare costs, retirement options, even required distributions down the road. And by the end of today's episode, what I really want to do is help make sure that our audience understands, one, that you have options that others don't have, that as a spouse inheriting a retirement account, you have options that aren't available to everybody. But the key, of course, is understanding that there are those options, what the options are, and not necessarily being an expert in all this by the time we're done, but just understanding, and always comes down to making sure you ask the right questions, right? And that's really what I want to make sure that we talk about. And that's actually, as we wrap up, that's what I'm going to share, is about 5 questions that I think will be really helpful, as well as an additional resource we're going to talk about just here in a little bit.
Okay.
And of course, as always, for all the links and resources, you can visit the simplyretirementpodcast.com. So before we get into the rules, I want to share why I think this topic matters, because we work with a number of widows. And when someone loses a spouse, again, there's dozens of decisions to be made. Some of them are emotional, some are legal, some are practical. Some can have financial consequences. They may last for years, right? And one of those decisions often involves a retirement account. It may be a traditional IRA, it may be a 401k. And besides the house, in many cases, that is the largest financial asset that gets left. And that's actually the case for many of the women we work with, is the IRA is the largest asset. It's even in the size of the account, we're talking, $500,000, $1 million. It's often a bigger value or larger value than the actual house itself. And that's why the decisions surrounding the account can have such a significant impact on retirement income, on taxes, on healthcare, on just your long-term financial security. Because many people just assume that next step is really simple. They just say, okay, well, I'll just roll that money I'll roll that IRA, my husband's IRA, into my own IRA and just move on. But that may not be always the best answer. And that's really what in today's episode, I want to connect directly to another episode that we've done in the past, and we've actually talked about a number of episodes, and that is the widow's penalty. So back on episode 66, we talked specifically about understanding the widow's penalty and what you can do about it. And we'll include a link to that in the show notes as well. But it really was around talking about how surviving spouses can end up paying more in taxes on less income. We discussed how tax brackets become less favorable in many cases. We discussed how a surviving spouse eventually moves from married filing jointly to single filing status, which can have a significant impact. And also discussing how required minimum distributions can become a larger issue later on in retirement as well.
Okay.
And we discussed how at the same time, actually, when we're talking about how the same amount of income for a joint tax return may fit pretty well. You may be in a relatively low tax bracket, but again, that same amount of income when you're filing single, those single tax rates are about half of what those married filing joint rates are. And that's really where that problem can arise. And here's something else I think is that really surprises a lot of people. According to the US Census Bureau, the median age at widowhood is approximately 59 and a half. Right? And if that 59 and a half age rings a bell, it's also the same age as typically you have to be in order to access retirement accounts. But why that's important is that obviously if that's the median age, that means half of the widows become widows before that age.
Right.
Some are a few years younger, some are much younger. But what happens in a situation where you become a widow at the age of 58 or 55 or 52, and that IRA account, that retirement account, is your biggest asset and potentially your biggest source of income? That's really where it becomes so important to understand what your options are.
Mm-hmm.
So at these younger ages, you're also maybe thinking about, what do I do about healthcare? I'm not eligible for Medicare yet. How do I manage the healthcare? Where's my income going to come from? And again, if this is your largest asset, how do I most effectively manage it? And for many widows, that's exactly the situation they find themselves in. They've got a retirement account. It's not just another investment account. It may, in fact, be the primary source of future income. And it also may be where we're trying to bridge a gap. And I'll share just a quick story about an existing client that we've worked with for a few years now. She went through this exact scenario. So she, at the time her husband passed away, she was 58. He was 62, had just retired, just started Social Security. And unfortunately, within just a matter of months, passed away. So basically, she found herself in this exact situation. She wasn't eligible for any type of Social Security survivor benefits. The largest asset they had was his 401k that was actually still with his previous employer. She was in a situation where she had no sustainable income. Not only did she not have sustainable income, she'd actually even have health insurance at that point.
Oh, that's terrible.
And so that's really, again, when you're thinking about how we make these important decisions, these critical decisions around an asset like this, it really comes down to understanding what your options are.
Okay.
And for her, we're going to break this down a little bit more in detail, but really that's where understanding or having an advisor that can work with you that understands these as well. And I think that's one of the things that concerns me so much is there's a lot of advisors that don't necessarily know these rules either. A lot of times, even if it's somebody that says, well, okay, let's just roll your 401k to an IRA, that's easier because number one, unfortunately, that's also revenue for them. But it's not always the best option. It really comes down to helping the client or the spouse, the surviving spouse, understand what their options are. And one of the things that's so confusing is that when you inherit an account, again, everybody often assumes that they have the same rules, that everybody that inherits an IRA account have to follow the same rules. And that's just not true. Surviving spouses receive special treatment, which they should, right? That would be obvious.
You would think.
Right. Well, and so when the spouse inherits a retirement account, there are generally two primary options to be aware of. The first is you can actually maintain that account as an inherited IRA. Okay. Second option is that, yes, you can roll that account into your own IRA. So both of those are options. And at first glance, those options may seem to be very similar because the money's still invested, the account is still there, the investments themselves may not even change, but it's the rules surrounding those accounts that can be very different because the distribution rules can change. The required minimum distribution rules can change. And maybe most importantly, the planning opportunities available to the surviving spouse can change. And you may even, that's one of the things also in terms of just flexibility, you might, if the wrong decision is made, you might lose a lot of this flexibility, a lot of these options if you didn't know that you had these choices. Because again, many people just assume that they're going to roll that money into their own IRA and that may be the best solution, but sometimes it's not. And one of the things that I think is confusing is you just think about what's the simple response. What's the simple thing to do? The simple thing is typically, yes, just roll that money into your own IRA and you're done. But what I talk about a lot is you don't want to necessarily confuse simplicity with strategy.
Okay.
Because the simplest answer is not always the best answer. The right answer is going to depend on your age. It's going to depend on your income needs, your healthcare situation, your tax picture, what your retirement goals are. And often sometimes, unfortunately, that changes if you've lost a spouse. What you thought retirement was going to look like is now completely different. We talk about this retirement income puzzle. All those puzzles now just kind of got dumped on the floor. Now we got to start picking those pieces back up and putting together into what your retirement picture is going to look like. And we need to know what assets are there and available to support you.
Like you said, this is like, she needs income.
Mm-hmm.
So, I mean, she rolls it over into her own IRA. She still has to follow the age requirements.
Exactly.
Right.
And that's where understanding these options is so critical. Now, one of the things that was interesting about her case is when we start kind of breaking things down, we said, well, let's make sure we understand what all your options are. So she, in fact, had the option. You can leave. There are rules that say you could leave that money in his 401k and you can actually access those before 59 and a half. So that was an option for her. The challenge for her, and the same challenge that is presented to many spouses, is when you take money out of a retirement account, there's a mandatory 20% withholding if you're taking out of the employer plan. So I want to make sure I'm clear about that. So not a retirement account, but employer plan. If the money's still sitting in that 401k and you take money out, there's a mandatory 20% tax withholding, right? And that limits your flexibility, especially when you have no other income. The likelihood is you may be in a very low tax bracket, but if right off the bat, Uncle Sam is getting 20%, that may be way too much. And yes, you may get a refund at some point. But in that moment, are you wanting to give Uncle Sam a chunk of money that you actually need? Because you might get it back, but it might not be until April 15th of the following year. And so for us, that's really what we were looking at, is saying, okay, she's under 59 and a half. We need to figure out where she's going to get income from. In her case, that's where it made sense to roll that money to an inherited IRA, which gives her immediate access. Yes, it's taxable. But in that case, within an inherited IRA, she could choose, do we need to have taxes withheld, if at all? And if we do, how much? How much could we choose to withhold in taxes rather than the 20% mandatory tax withholding?
Okay.
And that's when, again, we start looking at how all the rules play in and what's available to spouses that aren't necessarily available to everybody else. Another aspect of this decision involves required minimum distributions. So depending on your age, depending on your spouse's age, and whether you keep that account as an inherited IRA or roll that into your own IRA, future RMDs may be handled differently. And I think this is one that's going to really surprise people as well. So in some situations, especially if there's a pretty meaningful age difference between spouses, these decisions can affect when distributions begin and how much may need to be distributed each year.
Okay, so the age is what, it's going to be 73.
Yeah, let's recap the RMD rules real quick.
Okay.
So for years and years, it was 70 and a half, right? Then we had Secure Act. That made it 72.
Mm-hmm.
Now we got Secure Act 2.0, which makes it 73 if you're born before 1960, 75 if you're born after 1960.
Okay, gotcha.
Got it?
Yeah, 73 or 75.
73 or 75 at this point, yes. But here's where, again, the planning really, and the options, just understanding your options becomes so critical. Because again, we know there's, not every married couple is the same age, right? There's always going to be some amount of age difference, sometimes a greater age difference than others. But that's really where understanding your options of saying, okay, well, if I'm younger than my spouse who passed away, I don't want to be tied to his RMD age.
Right.
I'd rather be tied to mine.
Okay.
So maybe that's a circumstance where, yes, that back to that question of, do I roll it to my own IRA? Very likely the answer might be yes. Again, depending on age and all the other factors we've touched on. But I'd rather have those required distributions be based on my age rather than his if he was older. But it also works the other way. You say, okay, well, if I'm the older spouse and my younger spouse passes away, I want my required distributions on that particular money to be tied to his age. So if he's younger, longer time until RMDs might start. But this is actually a relatively new rule where we have some of these flexible options. But if you don't know their options, then you can't choose them. And that's really what this episode is about, is just understanding there's so many different options that are out there. But it all starts with looking at your specific situation, looking at your age. And again, we're already in the conversation itself is just make it on the assumption that a spouse has passed away to put yourself in this position. And that's really where when we talk about the widow's penalty, a big objective of that particular episode was what could we do prior to the spouse passing away? What tax planning strategies could we implement today to minimize the impact of the widow's penalty? Now we're just talking about, okay, yes, everybody would love to pay less taxes. But one of the things we want to talk about here is simply saying, okay, life is what it is. We are now inheriting an IRA from our spouse that has passed away. What do I need to know? What decisions need to be made, and how do I go about making those decisions? Hey everyone, it's Eric. Hope you're enjoying today's episode. I want to take just a quick moment to share a resource I think you'll find valuable. Have you ever found yourself asking, how much can I put into an IRA this year? Or how much can I earn before my Social Security gets reduced? Those are the kinds of questions that come up all the time, and the answers change often more than you think. That's why we created a free 2-page tax and retirement planning cheat sheet, updated for 2026, with the key tax, Social Security, and retirement numbers all in one place. You can download it right now at the simplyretirementpodcast.com/retirement cheat sheet. It's a simple reference you can keep handy whenever questions come up. Now, back to the episode. The other thing I want to talk about, and this is something that I see way more than, unfortunately, way more than I would like, and that is thinking, okay, well, I've got this big asset. It is my biggest asset. Maybe I should pay off some big expense, right? So taking a sizable portion of that account and paying off a mortgage, or maybe paying off a home repair.
Everybody wants to do it.
They do.
Yeah.
And it's natural to feel like that way. There's nothing wrong with thinking that way. The question is if you act on that and now it changes your entire financial future. That's where it potentially becomes a problem. Because you're talking about, and we've talked about IRMA, the income-related monthly adjustment amount on Medicare, right? I take a huge chunk out of my IRA after a spouse passes away, and 2 years later, I'm paying a significantly higher premium for my Medicare coverage, which maybe I do, if I use that money to pay off the house, that money's no longer there. So what happens if my cash flow is really restricted?
Right. That's
not one of those exceptions that potentially the loss of a spouse is an exception. So maybe that fits in. But again, it's all about timing. When did I make the decision to take that money out and pay off the mortgage? Was it 2 years down? Was it 2 years ago? Was it 4 years ago? When did that actually happen? And how's that going to play a role in my future income, in my future healthcare decisions? All these factors. But that's one of the things I think you have to be really careful about, is making, especially when you're in that phase of where these decisions are really emotional, where I have lost my spouse, and the immediate thing is I've got to do this. I've got to pay off my mortgage, or I've got to do this, or I've got to do that. And making that decision that could cost you significantly down the road, whether it's higher taxes, higher Medicare premiums, higher healthcare costs in general, and just restricting your option. And I think that's one of the things I would say, let's take from this episode, if nothing else, is just the flexibility. Understand that there, in fact, are options. You've got flexibility. You've got decisions you got to make. They're important decisions. But step back, take a look at what you have, ask questions, be willing to ask the right questions in order to make an informed decision.
Yeah. I mean, on one hand, if you locked into one of those really good interest rates for your mortgage, a lot of times people are saying it's not even worth it to pay them off because, the interest rate is so low. But on the other hand, if my spouse died, I would feel more comfortable not having to worry about making that payment every month.
Well, and I think a lot of it I was putting into perspective of what age are we at the time. Again,
right.
Median age is 59 and a half. That means half are younger, half are older. From a planning perspective, again, we always want to be as proactive as possible. So if you are, if you're in your 50s or even your 40s, do you have an appropriate protection strategy? Do we have life insurance in place? So that's also going to be part of the equation as well. But there is going to be that point where, farther down the road, if you are in your 60s, as many people are still working, we did that whole episode on, do I still need life insurance later in life, in retirement or nearing retirement? And if you've got a liability like a mortgage or even credit card debt, whatever the debt might be, always having some strategy, having a plan for how would I handle that if something did happen. And so that's really where so many people unfortunately get caught in the crosshairs is, well, I didn't do the advanced planning. Now I'm reacting emotionally. I've lost my spouse. I've got to do something.
Right.
And if that biggest asset happens to be an IRA or 401k, it's natural to think, well, if it's $1 million IRA, if I just take 500,000 out and I pay off my mortgage, I'll be okay. Not thinking about, well, that probably cost me an extra 37% in taxes. And depending on what state you're in, maybe some additional state income taxes and maybe higher Medicare because it pushed you into the top IRMA threshold. All these different things that you just don't think about when you're in the middle of making those types of emotional decisions.
Okay.
And that was the other thing in our particular case, in the client's case, where she had actually been out of the workforce about 20 years, right? So she was really in a limited income scenario where there was no income there. It was the 401k and that was it. How could we best utilize that 401k in her situation? Because she still had a house payment in that case. So are we putting her entire life at risk in terms of saying, okay, if she can't make a house payment, what is she going to do? And she had another daughter who was in her 20s and she was working as well. But it was just those two. And they were trying to figure out where do we go from here?
Right.
And that's really understanding those decisions. And again, working with a professional that understands those options becomes so critical.
Okay.
And in her case, again, coming back to some of the things we had to work through with her was at her age, she wasn't eligible for Medicare. She didn't have health insurance. That was her biggest worries was, what do I do about health insurance? Right. And so that's where the flexibility came in to say, well, we don't need to take a big chunk. We can manage your income in the current year. In her case, utilizing Affordable Care Act coverage and looking at the opportunity to take advantage of tax credits to help her with that cost. But it again came down to how can we manage the income using what in that case was her only source of income. And ultimately not triggering. And I think that's the other thing that catches people off guard. Again, when you're thinking about if I rolled it into an IRA, you brought it up earlier. Well, if I'm not 59 and a half and it goes into an IRA, technically, yes, you could still access those dollars, but you might be incurring an additional 10% penalty simply because I didn't know that I could have used the inherited IRA strategy. So as we get ready to wrap up, I just wanted to share what I would call the top 5 questions you'd want to ask if you are in fact inheriting a spouse's IRA. First one would be, do I need income from this account before the age of 59 and a half?
Good question.
That would be the first question. Second question would be, how will withdrawals affect my taxes? Right? And oftentimes that's going to take a tax projection to get an idea of what my other income sources are. How would withdrawals from this particular account impact that tax liability? Third thing I would say is, how will these withdrawals affect my healthcare costs? And there's different angles of that. That's number one, how is it going to impact my future costs for Medicare, but also is it going to impact my ability to get coverage? And that was one of the things for her, coming back to our example earlier, for her, when you're talking about Affordable Care Act coverage, there's actually a minimum and a maximum to be eligible for the tax credit. So you actually have to have a minimum level of income in order to even qualify for Affordable Care Act coverage. That's one of the things we had to figure out is how would we manage that to make sure she had enough coverage. She had actually enough income from this one source in order to make sure she actually was eligible for that coverage.
Wow, it's a lot.
Fourth question I would say is, what resources are available to support me during this transition? Looking at, do I have cash reserves? Do I have taxable investments maybe I could access? Am I going to have to go back to work? When will Social Security survivor benefits be available to me? And again, in her case at 58, she was still at least a couple of years. And even then, it would have been a significant reduction had she started at 60. So we had to, again, manage those income sources to put her in a better position to make those decisions.
Okay.
Question 5 then is, how will this decision affect future required minimum distributions? Could delaying RMDs be beneficial? Could lower future RMDs help preserve tax flexibility? And again, that's where we start looking at, is there an age difference between me and my spouse that needs to be considered? And again, I think these are all important questions, and they're part of the reason why surviving spouses often have opportunities that other beneficiaries don't. And I think that's, again, just being prepared and being asked those right questions. These 5 questions you won't have to answer in every situation, but this is a good place to start based on your specific circumstances. And I think they can help you avoid some of the most common mistakes that I see, which is making a permanent decision before understanding all those choices. All right. So just bringing everything together. So again, the goal of today's episode wasn't to turn you into an inherited IRA specialist. The goal is just simply to help you understand that surviving spouses often have more options than they realize. And if you've recently lost a spouse, one of the biggest mistakes you can make is assuming that the paperwork that is stuck in front of you is the only path you have. Whether that's you call the custodian, you said, hey, my husband's passed away. He had an IRA. What should I do? Unfortunately, many of the custodians, many of the customer service people you talk to at a custodian, whether it's a Schwab, a Fidelity, a Vanguard, or whatever, they don't necessarily know the options either. They might not know that you could use an inherited IRA strategy. They might say, well, here's the paperwork to move it into your own IRA. Now you've potentially lost a lot of the flexibility that you might have had otherwise.
Yeah.
Right. Sometimes rolling an account into your own IRA is exactly the right answer. Sometimes maintaining an inherited IRA for some period of time, at least, may provide valuable flexibility. Back to our client example, we only did the inherited IRA for a couple of years while we needed access to funds. And then we ultimately did transfer that into an IRA in her name. Because again, she was younger than her husband that had passed. Now we can follow her RMD ages versus his. So again, it's just a matter of understanding the options. And I think the key is understanding the trade-offs before making a permanent decision. And that's really, again, one of the things I would hope that our audience takes away from this episode is that the mistake isn't necessarily making a wrong choice. The mistake is not realizing you had a choice at all.
Yeah.
The inherited IRA that we talked about before was simply a strategy. The flexibility it provided was the strategy, right? It created an income bridge during a period when she, in her case, had very few options available. And for other surviving spouses, the flexibility may come in the form, again, better RMD planning, better options for tax planning, or retirement income planning over many, many years. And again, that's why I think understanding these rules really does matter, because they're not really exciting. I'm sure you didn't get excited when I told you what the topic was going to be for the day, right?
No, but there is a lot of questions here to consider for sure.
Right. Well, and again, back to what I wanted everybody to take from this episode is simply that: ask questions. Know where to start. Don't feel like you've got to make an immediate decision. Number one, have the opportunity to sit down with somebody who has experience in these issues, and know, when again, if you were to call that custodian and say, hey, this is what's happened, and they immediately say, well, here's the paperwork for your IRA to move that money to your IRA, tap the brakes a little bit. Say, hey, I think there's other options here. Can I get somebody who can help me understand those? Can we talk about what the other options might be?
Yeah, absolutely.
And I think before making any major decision involving an inherited retirement account, especially one that can affect your taxes, your healthcare costs, your retirement income, again, consider consulting with a qualified professional who can help you evaluate your options.
Mm-hmm.
Fun stuff, huh?
Like I said, there's so many questions. I mean, I'm just going to call my qualified representative.
There you go. That's the first place to start.
There's a lot to know, Eric. There's so much to know.
Well, and again, it's not to feel like you got to feel like an expert. Again, that's not the objective of our conversation today. It's to be able to know to ask questions. Ask the questions. That's the biggest thing. Those 5 questions will give you a good place to start. Then from there, it's just helping you make an educated decision. All right.
Got it.
That is it for today's episode. As always, thank you for tuning in. Thank you for Wendy for joining me once again. If you're looking for a personalized retirement plan that helps you make smart decisions around income, investments, and taxes, you can visit getmysimplyretirementroadmap.com to schedule a call with our team. For all the links and resources mentioned today, you can visit the simplyretirementpodcast.com. Don't forget to like, follow, and share the show. And until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
You've listened to Eric on the podcast and heard conversations about retirement income, Social Security, taxes, investing, and many of the financial and non-financial aspects that shape retirement for women. But you may still be wondering what sets Blake Wealth Management apart from other retirement planning firms. The answer is quite simple. At Blake Wealth Management, retirement planning is about more than investments. Eric's passion for helping women comes from the strong women in his own life, including being raised by a single mother and watching his grandmother navigate widowhood at just 62 years old. Those experiences continue to shape the mission behind this podcast and the work we do every day. Whether you are planning retirement with a spouse, navigating retirement on your own, or simply preparing for what may come next, the team at Blake Wealth Management is available to assist you with your retirement planning needs. Visit BlakeWealthManagement.com for a free retirement assessment or call 972-426-7237. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Blake Wealth Management and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.